Tariffs and real estate. It's everything going on this week. You have stock market collapsing like crazy. The mortgage interest rate is moving around quite a bit. And exactly what impact it's having on housing is something that's been hard for a lot of people to identify. I'm going to show you exactly what's going on with the housing market, exactly how the movement in the 10-year Treasury is affecting mortgage rates, and talk about where the opportunity might be in light of everything that's going on in the broader economy. It's important to remember that in 7 of the last 8 recessions, real estate prices have continued to rise. So we're getting to the point where people are starting to look at the 4 characteristics that determine if we're in a recession or not. People are trying to gauge, are we actually going to be entering a recession? Jobs and the job market are really still outshining the rest of the data. So it doesn't look like we're going to be there in the near future. But nonetheless, real estate is unlikely to be impacted like the rest of the markets, even if we enter into a recession. Looking at exactly where we're at, this is kind of probably a better representation of what we're seeing right now. So you have broader economic issues going on in the markets, and real estate really starting to shine in light of some of the losses. And here's why that's happening. First off, you've got January 13th here. We've talked about that date quite a bit if you've been listening, and that was a 7.26 interest rate. So that was sort of the peak of the run-up that we saw from September 16th when the Federal Reserve cut the rate. If you look here, since January 13th, I mean, just a remarkable decline in the mortgage interest rate. Now the index is showing 6.60. A lot of borrowers are actually below that rate, and this has a 1-day lag to it. And then this is an even shorter, but still remarkable fall off. If you look just back at February 24th, sitting there at 6.87, and now coming down with just, remarkable runoff the last few days. What does that mean for housing? Let's take a $600,000 home, say a borrower's putting 3% down. And on January 13th, they were looking at that house and they were looking at an interest rate of 7.26%. That was going to be a principal and interest payment of $3,974.21. The same exact home today, nothing else changed. Interest rate of 6.60, 3% down payment. These are 30-year fixed amortization. $3,716.99. That's a equivalent price drop of $29,500, or it's the same savings as what you would get if you reduce the price of the home 4.92%. This is fantastic news if you're a home buyer. If you're a home buyer and you've been in the market for the last 90 days and you're looking around going, my gosh, everything's so expensive, homes aren't coming down. If you're looking at a house that had, let's say, a 5% price drop over the last 90 days, and now you're seeing an interest rate drop of an additional 5% over the last 90 days, you're walking in with a mortgage payment today on a $600,000 house that looks like the mortgage payment on a $540,000 house. So tremendous savings and benefit to home buyers. And similarly, home buyers that were pre-qualified 90 days ago and said, man, you know what, it really doesn't look like I can afford all that much. Home prices have dropped in some senses. Now you have the interest rate dropping on top of that. Tremendous savings for buyers. So what you can expect to see as a result of this movement is a lot more buyer activity and a lot more pending home sales, homes going pending that have sat because there just wasn't a large enough buyer pool for it. We're going to start to see some absorption there. This is why this is happening. This is the stock market falling as much as it's fallen. This is all intentional. This is all orchestrated, right? This is the total public debt right now. The United States, you're sitting at $3.9 trillion in debt. And this debt was all, really since 2022, this has all been higher interest debt. You're looking at 10-year Treasury. This is the 10-year Treasury history. And going back to 2020, if we bring it a little bit shorter, this is what's being manipulated right now. So you see here we are January 24th. We've got the 10-year Treasury at 4.67. So this is new US Treasury bonds being issued at a 4.67 return. And now today, bonds being issued as low as 3.89, 3.90. This was a rate, by the way, on the 10-year Treasury that wasn't forecasted to be reached until much later in the year. So we're reaching that rate early. And you have to go all the way back. I mean, look, all the debt that's been issued, you have to go all the way back to October 2024. Really, if we want to talk about that lower figure, you have to go all the way back to October 4th to find a 10-year Treasury yield that's quite that low. And the reason that this is being orchestrated and manipulated is the federal government and Trump specifically are trying to control the cost of servicing the United States debt. So if you just figure a $3.62 trillion debt level, 4.8% interest, you're issuing 10-year Treasury bonds to pay off debt at 4.8%. Annual interest on that's going to be $173.76 billion to service that. If you see just a 3.91 like what we saw today, it's $141.74 billion to service it. So a savings of $32 billion a year just in refinancing that higher issuance by issuing lower interest bonds today and using the lower interest money to pay it. So that's why you're seeing this orchestrated manipulation of the stock market to force down Treasury yields. Tremendous savings on paying off the federal debt. How's it going to impact real estate? Well, this is what's going on with real estate, and this is just Southwest Orange County. You can look at any county you want. You see a similar story right now. We had lower inventory in January 23 than what we have today, right? And here you had 878, 793 in total inventory, now 1944. You can see inventory's basically doubled, right? There's basically twice as many homes for sale today as there was in 2023. And when you look at home price, you say, well, gosh, there's that many more homes for sale. If there's that much more supply, then you probably have prices not rising, right? Because if you increase supply that much, surely the demand falls. Well, that's not the case. You see price growth, it's really pretty tremendous. So you had $420,000 median sale price in January 23, January 25, $461,000. I mean, it's 10% growth over 2 years. And that's pretty consistent with what we've seen across Florida's real estate market. Reason being is, yes, inventory since 2023 is up. This is a national look at inventory, by the way, but we see the same story in Florida that's playing out most places nationally. You see inventory here, January 2023, and now you look at inventory real time today, and yes, you've seen inventory growth almost doubling. But you look and see we're barely back to pre-COVID inventory levels where we were still in a pretty deep seller's market. I mean, this was low inventory. This was low inventory. April 2017, August 2016, we were listing homes and we were telling sellers, yes, it's a seller's market. There's not enough homes for sale. Still in a seller's market, deep seller's market. Now we have, existing home sales supply that has really tripled from the valley of March 22, but we're still in more of a seller's market with less inventory than what we had even pre-COVID. So you still have low inventory. You still have strong demand, as we're seeing here in pricing. We can see in days on market, 61, now 74. I mean, marginal increase, right? An increase of, what's that? Basically 20% increase in days on market. But, we've gone from 67 days on market to 74, 10% increase in days on market. I mean, homes are still selling fast. They're selling for more money, and there's still not a lot of them for sale. Don't expect to see home prices coming down anytime soon. Case-Shiller, CoreLogic, on a national level, we saw 4% growth in price last year across all homes. And, I put this up here just as a bright spot. If you're sitting there staring the last couple days and absolutely freaking out about what's going on in the stock market, just remember there are stocks that are performing pretty well in this environment. 17% growth in the last 1 day in SPXS. 24% over the last 5 days, 40% over the last month. So don't just sit back. If you're going to keep your money in the stock market, don't just sit back and watch your money disappear. Look for some index funds, look for some alternatives that are going to perform well in an environment like this. But this isn't a stock market discussion. This is certainly more of a real estate discussion. So, going back to the real estate piece, if you're a home buyer, if you're a home seller, if you're a homeowner, what does it mean for you? Home buyers, what you should be doing is taking advantage of the current scenario before other buyers come back into the market, because we have critically low supply levels like we just saw. So home buyers who are pre-approved, you're shopping, you're looking at homes right now. Buy a home right now. Buy a home before more buyers enter the market. Buy a home before sellers see those buyers entering the market and see the demand and raise their prices. Go ahead and lock in this low interest rate. This interest rate is not going to be around forever, right? Like we've seen these valleys and these peaks here. If we shorten up this window just a little bit, we look back. I mean, these are meaningful differences here. 6.7 versus 6.82, 6.87, 6.6. I mean, you've got big swings here, and you've got borrowers that locked at peaks and borrowers that locked at valleys. And if you go back just a little bit further, like if we take it back to, let's say, December 1st of 2025, you'll see even more swings that occur. And this isn't unique to just this year. I mean, there's in any segment here, you've got people that were all shopping for homes there, January to February 2025, peaks and valleys. Same, you have the difference between somebody who bought a home in November 18, 2024, and somebody who bought a home in December 17, 2024. You could have a 6.92 rate or a 6.68 rate. So if you're a buyer, we're in a valley right now. We're at a low that we haven't seen really since all the way back to October. You have an opportunity to go in, lock in a very, very, very low competitive interest rate when there's relatively less buyer demand in the market, and still triple the amount of inventory that we saw just a few years ago. If you're a buyer, you should be going out and buying your house and negotiating while you still can, because if these conditions continue, we're going to see rates fall even more. We're going to see tons of pent-up demand entering the market. We're going to see bidding wars again, and sellers are going to immediately start to raise their prices and become less negotiable. If you're a home seller, what you should do? Well, it depends on if you're going out to buy another house. And if you're going out to buy another house, if you're a home seller, get pending, get under contract, get to the right price, and take advantage of the opportunity you have on the buy side. If you're a seller and you're just an investor and you're exiting, offloading properties, be patient. Wait, hold off. Timing and the market are on your side. Every single day that goes by right now, your home is becoming more affordable and more affordable and more affordable. So don't panic, relax, let the seasonality, April 13th to 20th, arguably the best week there is to be a seller. Let the market help with you. Don't get over anxious, be patient, and chances are the interest rate's going to fall, buyer demand's going to pick up, you're going to get your price. If you're a homeowner and you've been waiting to refinance, if you've got this 18% credit card debt going on, if you've got a HELOC that was adjustable and you didn't realize it, and you've got high debt, 11, 12%, 10% on a HELOC, and you're struggling to keep up with that, now is a good time to consider a refinance, right? You can probably refinance, use some equity to buy the rate down. A lot of borrowers, especially if you're well qualified, are going to be able to refinance into the mid fives or even potentially the low fives if you pay some points. So if you're a home owner and you've got some high interest debt, whether it's vehicles or credit cards, whatever it may be, and you've been waiting, struggling, looking for an opportunity to liquidate some cash, finally, we're at a point where you can make a good argument for a permanent refinance, cash out refinance, do some home improvements, get rid of some higher debt. If you have any questions at all about the market in Florida, we have offices in Central Florida and the Space Coast. We can help you with purchases, with refinances. We can help you list a property. We can help represent you on the buy side and help you get a great deal when you purchase. My name's Don Harkins. Don't hesitate to reach out to me. We'll continue to monitor things and keep you as up to date as possible. Thanks for watching. Have a great day.